Hey everyone, welcome back. It is September 9th. My name is Levi Woods. This is Drawbridge Finance, and this is an opinion channel only about money, about finance, about things, trading, whatever it is that you're doing, we can talk about it here. This is my open session, so it is public. Everybody's here. Thanks for joining me, Kevin. I see you're online. You guys know the drill. Let me know where you're watching from. And today I'm going to talk a little bit about a whole bunch of things. I've been away I was away for most of August. I was, it's summertime. Did a little bit of traveling. I don't know if you guys saw some of my videos. Moo Financial was nice enough to invite me down to New York City for a weekend event where we got to do a private tour of the NASDAQ. I went with a whole bunch of other influencers. I hate that word, influencer. It's like, what do we say? There's, that's a bad word. YouTubers, people on Twitter, other social media like Blossom, things like that, where there was a bunch of Canadians there, there's a bunch of Americans. Shout out to everybody that I met. Man, it was a fantastic couple of days of just like hardcore talking about options. And we went to a baseball game. I don't even think I watched an inning. It was just like, all we were doing was talking about potential setups, what we're doing, what we're looking at, what the market may do, how do we appeal to our audience, how do we generate more leads, all of those things that are happening. But the majority of it was about Moo Financial. Now I'm going to post a link. I've posted the link in the chat here on YouTube. And now this is a private link to, or not a private link, it's like a referral link to Moo. Now, the cool thing about what they're doing is that they are a brokerage focused on listening to traders and actually making a platform that is better for us, which was part of the reason that they brought us down in a big group. So there was people from Japan, Australia, like it was a global event. And we were actually in a room together in New York, and we got to sit down and look at the platform, and we got to give our feedback as to what was good about it and what was not good about it, which was pretty awesome. So we're going to get into looking at some of that stuff today. I have opened a very small brokerage account with them with my own money. I'm actually trading live in that account. There's going to be some more information coming within my Discord, some specifics about everything coming out and what I'm doing, how I'm planning on trading that. The idea is that I am starting to use Moo as a platform to see if it will replace some of the other trading platforms that I will eventually move away from if I feel like that's the appropriate choice. So far, I have to say it's been fantastic. So we're going to look at that. Thanks, Mike, for letting me know, or thanks for saying welcome back, and thanks for the email this morning. I did want to touch base on your email actually about the Roundhill product. So Mike was nice enough to send me an email this morning about Roundhill, and which is something that I've been trading, I've been holding. Charles Schwab is not allowing electronic processing of some of the ETFs. Now, Schwab has done this before with some of the money market funds. So it's, if you do a little bit of research on what specifically they're trying to do, is Schwab wants the ETFs that they sell to be priority for their customers. So as a brokerage, they can do that. Now, I couldn't find anything specifically on why the RDTE, which is the Roundhill ticker specifically that was mentioned in Mike's email, why they may have delisted that or made it a little bit harder to trade electronically. You can still trade it, you can still buy it, you just have to phone in your trades. So why they've done that, my assumption would be that they're trying to keep everybody in their ecosystem. We see other platforms doing this as well. I don't know if you guys saw this week, Wealthsimple raised their credit card fee from 120 bucks a year to 240 bucks a year. But what they're doing is they're incentivizing people to say, hey, if you keep enough money in your Wealthsimple account, or if you hit these certain parameters, you get it for free. So they're upping the cost of entry, and everybody seems to be doing this. It's like, if you are working within BMO's architecture, they are really raising the limits to make sure that all of your money is there and that you can't really split your money around into different brokerages. I don't really agree with that. It's why I don't love the banks. Like, one of my personal rules of investing is invest in banks, not their products. So we have to remember that. Real brokerages don't need that kind of thing. So let's get into where I'm going to pull up. Where's this link here? Look at this. Look at this fancy picture they put together for me. I'm going to just pull this up and just show you. We talked about it. There is a link in the chat for Moo Financial. This is the one of the new platforms. It's available in Canada. It's available globally. So there's right now there's forgotten how to use my pointer here. Deposit any amount, get 6% on uninvested cash greater than $10,000 Canadian within 60 days. You get sign up. There's like commission rebates. There's a cashback bonus, $300 back if you deposit $5,000, or you can get up to a $2,300 Apple gift card. And again, using links for people like myself, who, that we're on the internet and we have these links available and we use the products. When you use these links, then we get a kickback for it. You get the best possible deal and you get bigger kickbacks typically. It's a way for everybody to promote the products that they like. So anyways, that's my sales pitch for Moo today. We're going to look at the platform a little bit, but before we do that, let's just look at the market and see what's going on. We can see, I had drawn this blue line on here before, these lower lows that we saw 1, 2, 3 times it hit these lower lows. We broke through it a little bit over the last couple of weeks, but then we kind of have surged up above. We're very, very tight on the top of this Bollinger Band on the SPX. It's up, trading up right now, 0.2% today. But, I would be concerned about a pullback, and a fairly significant one. We could see a pullback down to the 6,000 level pretty easily. So something to think about with our long-term portfolios. We also expect that the Fed is going to drop the interest rates next week. Next week, when is it? When's the date? September 18th? September 18th, I think, is the announcement. So in a week and a bit. But that is the expectation that interest rates are going to go down. NQ hit... NQ futures, I thought we hit all-time highs yesterday. We closed, QQQ I think closed at all-time highs, but the futures are slightly down from highs that we saw back Tuesday, August 12th. So just a month ago, we're seeing a little bit of consolidation. The question is, are we going to break out from this? Or are we going to have a surge to the upside? Russell finally, moving up. I've been gone for most of August, and we saw this move that I talked about. We were looking for that expectation to rise up closer and closer to the top of this band, which it has. And one of the things that's happening is the VIX is very low. So we have to be strategic about how we're putting in trades and what we're doing. And I'm going to show you something really cool in the Moo platform that I love comparatively to IBKR. US oil trading at 62.63. You can see I've got this green band here, these two green lines. That is my expected max profit range for my patrons. They know, they see these trades in the Discord chat. They get to see live what I'm trading, exactly what I'm putting on. So when I talk about it here in the live streams, I talk, just kind of generically, this is what I'm going to do. But of course, I have specifics for each of the trades that I have on. So if you're interested in that, you can head over to patreon.com/drawbridgefinance. You can sign up. There's 2 different tiers. There's option tier, dividend tier. And I am launching some new changes here coming up. So there's going to be a new website launch. There's a bunch of things we've been working on, but just been fantastic. Other than the constant trades, developing just so much stuff. And I know that it's been a little bit cumbersome inside of the Discord chat the last little while because I've been trading so many different things and just kind of piling it on. What I'm trying to do is give information for everybody. I've got people that join and they're like, just want to do cash secured puts. Well, great. I need to put enough of those on that people can follow and see what I'm doing, how I'm putting those on. So one of the things we're going to talk about is cash secured puts. We're going to look at some notes. I was having a conversation this morning with one of my members on Discord. And we're talking about selling puts. Let me just zoom this in just a little bit so we can see this. I could probably do that easier if I just do this. There we go. So selling puts. These were, I was actually out for beer and burgers last night with Chad, who was writing this morning. We're talking about how to think about what we're possibly doing when we're selling a put. And he wrote these notes based on some of the stuff that I was saying. We had some conversation last night. We had some continued conversation this morning. And here's the Cole's notes. I think that they're pretty good. This is a good indicator of what I'm looking for when I'm selling put. So selling a put is a bullish position. I think that is the key factor when we're looking at this. People think that selling a put somehow is like a neutral position, but it's really not. There's a short delta position to it. So there's a long delta position to it. There's a capped profit, but if the underlying sells off, it loses money, which means we want to enter short puts when we think there's a buying opportunity. And we have to use certain resources to figure out whether or not we're at a buying opportunity. So with short puts, you typically make money if the stock stays the same or goes up. This is referring to selling out of the money puts when a put is below the current price. Now, we can still make money on and out of and in the money put as well, which is a synthetic covered call. For those of you who you like to compare those types of strategies, selling a short put that's in the money allows for extrinsic value decay and it allows for a little bit more potential. It's a little more aggressive a trade. So depending on how aggressive or how much risk a trader wants to take, selling the put up or down the chain gives a higher potential reward for higher risk. What it is, selling a put is an agreement to buy 100 shares. So you would only have to buy them if the stock is trading under the stock price. So in this case, if a trader sold this 160 put, they would be on the hook to buy 100 shares, buy the shares for $160 a share. And there's 100 of them. So a debit of $16,000. When you sell a put, you get paid a fee. Now, in this case, this particular what we were talking about was NVIDIA. I can pull that up and we can take a look. Let's just go over to NVIDIA and take a look at the options chain. So I'll just go to NVIDIA. And when we're looking at a stock like this is Moo's platform. We can go to the options chain. It's got these fantastic like strategies that just come up. Like, man, that is killer. The fact that this just pops up, we can just choose a date, so October 17th, and it just has at this point in time limited number of strategies. It's got like short straddle, short strangle, long butterfly, long put butterfly, and you can just click trade on a click of a button. Pretty amazing. I'm not going to do that. I'm going to look at the chain. We're going to look at this is September 12th. I'm going to open up. We've got earnings coming up November 19th, and you're going to see a note in the short put selling about whether or not we want to avoid earnings or not. In this case, we're looking at the October 17th, which is 38 days away. Sorry, no, we're looking at, Chad and I were looking at the October 10th. And one of the things I was looking at was these quite aggressive trades, like a delta of 30. So when we see that, we know that we have about a 28% chance that the stock is going to be trading under 160. And we have a 72% chance that the stock is going to trade above 170. And what we can do when we click on this, Chad and I were looking at this morning. NVIDIA was down. We were actually looking at it last night and looking at the prices there. It was worth $340. It's currently worth 320. It's already lost some value. This happens when the stock moves up. If NVIDIA moved down, this would become worth more money. And as a premium seller, what we're doing is we're collecting that money. We're collecting $320 in this case. When we look at what this curve looks like from a profit perspective, we can kind of zoom out. We can see how much risk we're taking. Now, if NVIDIA was to go to $86 a share, this trade would lose at expiration. It would be lose $7,000. This is a $16,000 position that could lose $7,000. It has a substantial risk to the downside, and this is why I say that these are bullish trades. Let's zoom in here a little bit and see how much we could make. Now, the profits are capped with a short put. So at expiration, the most I can make is this green line. Expiration P&L is showing here at 325, and the current P&L is negative. So if the stock was to run up today, if the stock was to run down to 160, we would actually lose money today. It would devalue by about $300. So there is risk, there is a slope. The thing about this trade is what we're looking at is saying, well, this is a high probability trade, much higher than buying shares. If we buy shares, we only have a 50% chance of making money. This has a probability of making money of 73%. So we have a higher probability of making money. Our max loss is lower than if we bought shares today. If I bought 100 shares today, my max loss would be $16,825 because I could lose the whole value if it went to zero. If I put in this trade and I sold the October 10th 160 put and collected $322, my risk is actually considerably less. It's only $15,675. That is $1,000 less risk. Now the max profit is where we differ. The max profit is $325. So remember what we're trying to do. The cool thing about Moomoo is I can just drag this around. I can see what my max profit is. I can take lower risk. I can sell the 145 put. And my max profit is now $88. My max loss is $14,000. My probability of making this money is how much higher? 91%. Now, selling anything that has higher than 90% is actually pretty risky. It's actually riskier than you think. And the reason is because the reward is so small. So what I like to do is I like to use my calculator to calculate how much risk, like how much reward I'm getting for taking this risk, because no matter what we do, there's always a possibility that the stock could go down. There could be some catastrophic event. And if that was, I have to take that into account. So in this position, I am tying up capital. I'm tying up $14,500. And what is the potential reward and what is that on an annualized basis? Now my Rourke shows me very quickly how to do this and what the expected annualized basis is if we just put that in. But what we can do is we can calculate it. We can say, what if we made $88 divided by a max loss of $14,412? And what is that return? Well, the return is less than 1%. And we're doing that in a number of days. So this is 31 days. So I divide that by 31 and then I times this by 365. And you guys see me doing this calculation all the time. This is what I want to know. This is a 7% return on capital. So selling this position is actually not that bad. Making, if I had $14,000 that I wanted to allocate towards NVIDIA, I could put in this position and say, I'm willing to buy stock at $145 and I'm going to collect this $88 today. And if that annualized makes me 7%. For some people, if you're a retiree, that's a fantastic return. If you've got a $1 million account, this is making $70,000 a year in cash flow for selling the puts against NVIDIA. Now, I typically play these a little more aggressively. The idea is that I'm looking at the stock and I'm saying, hey, here's NVIDIA's chart. I actually think we're at a good place to buy. I'm going to show you one of the. Let's just look at this chart settings here, scales. I want to put the price on the right. I'm just going to change some of this here. I did that earlier. I don't know why I didn't save it, but I want to see the price here, 168. Here's the percentage change. When we look at these, I often am, how do I put a horizontal line in here? I'm pretty new to this Moomoo platform. I've been trading on my phone quite a bit and it's been great, but what I haven't done is played with it on the computer. So I'm starting to get used to it. So here's that 145. I mean, that is way out of the money. I mean, that's the level that I would have been buying if I sold the 145 put. And if it didn't go that low, then I make $88 in a month, which is a 7% annualized return on that cash secured value. Now, I was looking at the 160 and I was saying, we've already seen this run up. I know the stock was trading at $86 earlier this year, but this stock, almost all the analysts are expecting that the stock is going to be worth somewhere up here in the 190, 180, 170 range. And how do I know that? Well, we can see that. We can go over to a platform like investing.com and I can look this up. I can say, hey, where's NVIDIA and what is the current the fair value? Well, here's the current fair value right here, 160. So that if some of the calculations are working out that the fair value is calculated at 160, why wouldn't I be okay buying it at fair value? That sounds good. It's trading slightly higher than that, so I may not want to buy it at this level. How much can I make if we go to that? I'm going to go back to the table here, and we've got the 145 on here. I'm just going to go to the curve. It's really easy to just slide this over. I'm going to slide this over to 160, and now I'm going to look. What's my max profit? I've got a 73% probability of profit, max profit of 325, max loss of 15,675. So I'm taking a bit more risk by doing this, but I'm also making a little bit more money if the stock stays above 160. 325 divided by 15,675 is 2%. And we divide that by that 31 days, we times that by 365, and we get a return on capital, 24.4%. So that is the type of trade that I'm looking for. Now, of course, if we take more risk, we could actually sell. I talked about selling in the money. What if I was bullish and I thought that NVIDIA was going to go up? What if I just sold the 175? Well, look at how much money I collect today. I have a 56% probability of profit, which is still higher than buying stock. I have a max profit of $1,000. I have a max loss of 16,495. Now, that's still cheaper than buying this stock today. Stock today would cost me $16,818. In this case, I would be collecting $1,000. Right out of the top, I would be collecting $1,000, and I would have until October 10th. Now, if the stock traded up above 175, like I think it might do, then I just get to keep the money. It expires worthless. And if it's below, then I just pay the difference. If it's $10 below, like it is right now, then I pay, or sorry, if it's $7 below, like it is right now, then I would pay $7 to close this option, and I would have a net profit of $300. But if it goes up, I have made a considerable amount of money. So again, we can do these returns. And again, this is a bullish trade. So if I did that 175 and I made $1,000 divided by the amount of risk, 16,490, this is a 6% return, because I'm capitalizing on the fact that the stock is going up. We divide that by 31 and we times it by 365. Now, this requires a move to the upside, but if that happened, it's making an annualized return of 71%. So if you've got good timing and really feel confident that the stock is going to go up, selling it in the money put is a very easy way to get long deltas. No buying the stock required. We just sell it, collect the money, sit back. Trader Bob says, welcome back. Thank you very much. Bob says, enjoyed your no risk trade video. Can you talk more about finding good stocks for that? Does it require large cap dividend stocks? Do you look for delta, theta profile? Can it work with synthetic? I have spent quite a bit of time working with synthetics. I could, as you see, I do these demos when we're looking at something. Let's look at NVIDIA and just see if we can come up with something. Now, we know from those no risk trades, what we need to do is find a sweet spot at some time frame where it actually makes sense that we can make some money. One of the nice things about Moomoo is that it has these little butterflies in here. What I'm looking for is high reward potential butterflies. And when we play the short duration, they're often fairly even. Max profit 264, max loss 171. This is on the 3-day weekly. If we go out to September 19th, we'll see that we can find some trades that are wild. Look at this long call butterfly, risking $18 for a potential of 167. That is the type of setup that we need to be able to start this type of trade. So unfortunately, I can't just click on the chart. Maybe I can. I'm gonna try. Let's try here. Here it is. We've got the I've got these positions. Let me make this a little bit bigger here so we can see everything. Here's the butterfly. So what we're doing is a call butterfly. We've got the 166, 168, 170. I would try, what I'd like to do is try to just widen this out a little bit. So let's see if we can do the 165 and the 170. Can I zoom out here? That's another thing we can do, is we can actually do these as a broken wing. So what I want is to be able to make like a decent amount of premium, because when we're doing a zero risk trade, we're actually putting on quite a big amount of capital. So I'm just gonna scroll this out here until we get an even butterfly. What's not working here? We're the 168. So let's look at the 167.5. That'll give us some more even butterflies. We've got the $198 in risk, and we've got a potential expiration of up to $500. Now, a $500 potential is something that I might consider for a position that's this large, because when I do the conversion, I'm going to be purchasing stock, and we know that that stock is going to cost $16,000. So let's look at the changing the lowest portion. So I've got the 160, 167 and a half, 165. This is only 10 days away. I may not be able to make this work. We're going to convert the call to a put, and we're going to add a stock leg. So where do I do that here? Add underlying, buy NVIDIA. So this is not risk-free, but and let's look, is there less risk? It's the $190 P&L, and we have a potential making 536. So let me convert it back to the calls and just delete these 100 shares. We had expiration P&L of $230. So it's a difference of about $40 in risk, taking an additional $40 in risk just doing the butterfly itself. This might be a better strategy overall, just doing the butterflies. The zero loss trade is great synthetically, but all we're doing is we're tying up capital that we could make money on. Remember, Moomoo's promotion right now is that if I have extra money sitting in cash, I can make 6% return on it. 6%, instead of having it tied up in a trade, it makes up for that $40 difference. So it really depends on what we're looking at. Typically, what these trades need is to go out a little bit further in time. You saw that I did them in like the November cycle. So again, what I'm looking for is a wide enough position that we have little amount of risk. So expiry, there's $142 in risk and a high potential profit. This is up to $800. So we start with something that is very symmetrical and it's very, very tall. Let's just do that conversion again. Look for the put and then add the stock. So buy. There we go. There's a zero loss trade. There it is. And again, the problem with these is that the expiration P&L might be really, really low. One of the cool things about this is that we might be able to set this up based on, we can see the expiration curve. So that's the cool thing. Look at what happens. How much money do we make as this goes by? At 30 days, at November 2nd, so we're halfway through the trade. This basically has made $189. Now, is that enough money? If we don't want any risk at all, is this enough money to pay for an annualized return? So what if I made $189 and we divide that by the amount of output that I would put in here? There is no risk on this trade. The max profit is $1,000. The max loss is 0. It's got 100% probability of making money, because the whole point of it is that it is zero loss, but it's tying up 16,000 in capital. So we're 16,000 in capital. We divide that, and so it's making 1.1%, and we divide that by the number of days, which is 73. And we times it by 365. A rather simplistic setup, but this is making 5.9% return. And again, we compare that to, if you can make better than that, then there is potential of just holding that in our account. Now, it could make less. What if the stock dropped? Well, look what happens. If the stock goes down here, or goes way up, say NVIDIA goes up to, then we're outside of the potential tent. And eventually we get to this zero line. But the day before, if you can hold this a long time, and this is why you want to play on a short as duration as possible, if it stays in the tent, there's potential of making a lot more. So we've got a scenario where if it's moved outside of the tent, it could make a little bit less. If it stays inside of the tent, it could make around 6% a year. And it definitely has the potential of pinning right close to it. So this is where what I would do is I would try to center these around where I think the stock is going to go. So this one would be centered on November 21st at that 170 mark. And I would just go back to the chart on NVIDIA and say, Well, here's, where is 170? 170 is right here. So if I thought that that was the place where it was going to be, then that's where I would set the tent. Let's move this whole thing up. Let's just see what we can do. Can we make it a little bit of a different trade? What if we go 170, 180, and about $10 wide is 190 and then 180. About $10 wide is where these are going to function. So again, you can have it's no risk at all, and this is centered at 180. So we can really, just pinpoint this exactly where we think it's going to go. Are they easy to move around? Relatively. They're still making money kind of every day if they stay within the 10. So it's a very interesting setup if we're worried about it. Now, what if we made it asymmetrical? What if we took a little more risk to one side? I mean, that's kind of an interesting thing as well. Like now we've got a max risk of, $248. We have max potential of landing in this 10. What if we did it the other way? What if we tighten it? What if we widen the call side? Tried to make this butterfly further. Well, here's a trade that's quite interesting. I mean, if the volatility increases, then if the volatility increase won't affect this trade all that much. If the increase is tons, then it's getting nothing, but it'll still eventually conform to the shape. If the volatility drops, which it's unlikely because it's 15, already 15, it's pretty low, then it conforms much more tightly. So we can see how that adjusts the volatility. The key here is how much risk are we taking? Like if the date goes by, this has a little bit of risk to the upside, but it has a big profit tent. $1,300 potential, which is pretty awesome. And that's how I might play this. What if I tightened it up a little bit more? What if I took no downside risk? Now I've got a break even of a 192. I'm creating, basically a put butterfly or a call butterfly. We can do this with calls if we want. I can just convert this to a call and I can remove the stock. But you can see the profit is way less on this. Now the expiration P&L is only $50, and I'm risking expiration P&L is 590 max loss. By adding in that stock, we're using something that we may keep in our account anyways, and we're really increasing that P&L. The expiration P&L is $200 to the downside, and the max loss is only $800 to the upside. So it ties up more capital, but some people are sitting around with capital just sitting in their account anyways. So it depends on what you want to do. I hope that kind of answered your question. Kind of got off topic here, but let's, and I see your question about Starbucks. Let me just go back to these notes about short puts because it's already 11:43. We're going to go through, the position is, so selling a put, just selling a put. The position is called the cash secured put because the trader has the cash and the intention to buy the shares at 160 a share. If it doesn't go below 160 a share, the put expires worthless and we just do it again, rinse and repeat. Now, it can be quite lucrative doing this. It can be terrible if the stock goes down. So it's important to understand that you have to have the short puts at a level where you are comfortable buying the stock. As long as the strike is at a good price per share, it is a very good strategy because you only ever buy stocks when they're low, and you can make money every month if the stock stays the same or price goes up. And this is where it's like that risk to reward. I don't want to take trades where I have lots of risk to make 7% a year. If I want to have if I want to make only 7% a year, it doesn't make sense to sell a put that's way out of the money. That 135 put that we looked at in NVIDIA was way too low. I would much rather just tie up the money in that butterfly and hope to make, somewhere between 2 and 10% a year. All I have to do is hit in that butterfly every once in a while and hold those to expiration. It's a much simpler thing to do, to have those zero risk trades on. If my goal is to make 7% a year, why take the drawdown risk when we don't have to? And that's the thing about being a complex options trader, is we can choose how much we want to portfolio allocate to certain stocks and to certain strategies. So short puts are great if we're in a bullish market and if the stocks are priced appropriately. So Chad has some notes. Look at stable companies that I would actually want to buy the shares. And if they actually went below the strike price, do I want to buy it? That is like number one. Is it a good price already? Then number two, check other multiple sources, investing.com, bar charts, IBKR, Moomoo, any of these. Let's look on Moomoo. Where is, if we just go to NVIDIA, let's see if we can find this here. If we go to profile, valuation, target price. So, here's the, it's a strong buy rating right now. Strong buy consensus rating based on 38 analysts. And here's the target price, max 250, average 212, and minimum 100. So it's currently 168, but you can see that the average is 212. There's a bullish sentiment. And we can do that with any stock. So let's look. I know there was a question about Starbucks. So let's take a look at Starbucks right here in Moomoo. So we're going to pull up Starbucks on the US exchange. We're going to look at that valuation tab right away. We can see max 115. That's the analysts. So this is 21 analysts. 61% of them rating it a buy, 33% a hold, and one of them it looks like a sell. So they have a price. They have a price target, and then when they did this, and this is from institutions, we can look at individual analysts as well. So we can see what their star rating is, whether it was downgraded, upgraded. Pretty awesome. Now, I'm not an analyst. I'm not doing this kind of thing. You don't see me on here. I've traded Starbucks a ton. At $83, I feel like that is a buy because I've traded Starbucks when it was at 105, and we traded to the downside. When I see that a stock is trading down near the low valuations, I typically take bullish positions, and we can see that we've got a buy rating on here. Most people think that it's going to go back up, around $100. From trading this, if you just look at the chart, just go back in time and look. And the thing about being a trader is you find that these stocks just trade in a range all the time. They're just compress this down. Let's go like this. Let's just go here, and we're going to scroll back, and then we're going to draw some lines on here. Here's the peak. How do we put this on? Whoa, that just made that disappear completely. Okay, that wasn't the key. I was trying to do a horizontal line. I'm trying to guess what the horizontal line is going to be in Moomoo. But let's do it with, no, I have to put it in here. I'm going to draw a horizontal line. I'm going to draw it here. And then I'm going to draw one here. You can see what I'm doing. I'm just getting the highs and lows. That's it. There they are. That's the range. And it really becomes apparent when you scroll in. And then when you scroll back out, you get to look at the noise. So let me just go over here and see if I can figure out how to use this chart. But we can see what happens. Stock trade, there. We've just completely dissected what happens with Starbucks price action. This is cool. This is the kind of stuff I'm talking about. I'm looking at Moomoo right now. Look at this. This has got a bearish flag on here. So it is recognizing a pattern that is typical, and it's saying if there's a breakout, are we going to see this? This is going to be downward momentum to the downside. When this breaks, we're going to see this down. So what I might look at this is I see earnings here. We saw earnings July 29th. That was pretty recently. We've seen a downward move from there. We've got downward momentum. We've got this upper level at 117, and we have this lower level. Let me just turn myself off here for a second, around $70. So how do we play this? How do we set this up? What would I do? Well, in this case, what I might do is just look for a strategy. So here's a short strangle. This is September 19th. Let's go a little bit further than that. Typically we want to give ourselves a little bit of a range so we can sit back and relax and not be stressed about our positions. But here's a short strangle. This is selling the 80 and 80 put and selling the 90 call. And that gives us a range between 77 and 92. And if we go back to this chart, we can just look at what that looks like and say, what if there was some other lines on here at 92? Here's one of the lines. That's not that high up there. There's 92, and then where's 77? Again, I have to, oops, sorry. sorry, but I'm pushing buttons close to it. I'm trying to turn myself off. 70, 77. Here we go. So that is, got to figure out what the hotkeys are here so I can do that in real time for you guys. But there's that range. So we're here and we're saying, okay, well that's where the strangle for October is. And then what I would do is I would mark a vertical line in here. So I would pull this down, I guess, and there's got to be a hotkey, but October 17th, and I would mark that vertical line on there. It's kind of fun. So now I've got my box. That's where the stock would make money in that strangle setup that Moo is pulling up. So that's in the options, and these are just real time. They're just pulling these up. I can get more complex than that for sure. So let's click on the trade button. Let's get that loaded up. And I might say, well, I want a little more downside protection. Well, just drag it over. That's as simple as it is. There we go. There's the sell the 70, sell the 90. What's the return? Max loss is unlimited. Max profit's 140 bucks. 77% probability of profit. I can skew it to that side too. I can say I want to have more downside. I can take that risk off. I'm like zooming around here. I'm trying to get it in a place where we can see. What else can we do with this? One of the things that's going to happen is, over time, it's going to conform to the shape. And typically with strangles, like if we're doing naked strategies, I like to just get out of them. If they're in the range, I like to get out of them at 50% of the time. So if I'm selling 38, like at September 30th, it's already made a bulk of the money, especially if it hasn't moved at all. So take the profits and run, get into the next position, recenter. But if we're doing limited loss trades like a condor, if I was to add something here, if I was to add a, say buy a put in here to limit the loss, I don't know why it put it there, but let's move the put over to this side. So now I can say, well, here I have limited loss. Maybe I move these both over. Maybe I move the short put to 75 and then I buy a put at the 70. What I'll be able to do is create a trade that matches the profile that I want. So this maybe has a little bit too much risk. It's 76 break even, but it's pretty cool to see this. If the stock goes down, the IV will increase. So you'll see that this can be a losing trade. Even if we're halfway through and the stock has dropped, it's a loser. What I would want is something that builds a profit tent to the downside. And we can do that. What if I move the put? Just gonna play with this a little bit because you guys are asking about like how we figure out trades, how we, and having software like this that really allows us to build something is pretty cool. I'm gonna add another put down here and I'm gonna define the risk. So if I have a call and two puts, I'm gonna add another put and I'm gonna put it below. So this is the 45. I don't know why it won't let me go. Well, we're way in crazy land here. That's why, because what do I want to sell? I want to sell, the put that I want to sell is going to be like the 70 strike. And then buying the puts, I want to buy a 75 put. So maybe it's better to just, rather than select it. And then what I can do is I can sell two of these and then buy this put. So if I thought it was going to go down and I wanted to do something like that, it's a pretty cool setup because even if the IV increases, I'm going to be profitable if the stock drops down into this tent. So, and again, Starbucks is at 83. This is a bearish trade. And I could slide this over if I wanted, and this would give me a nice little profit tent. This trade right here, almost like a scorpion. Scorpion wouldn't have this 60 put on here. That's a scorpion, we call that. So we've got a put ratio spread to the downside where you've sold two, bought one, and then sold a short call above it. This is kind of one of the trades that I like to play because as if the IV doesn't increase, if it just drifts down, it very much conforms to the price of the tent. And if the IV increases, it's still showing a loss. It actually is showing a loss if we have IV increase, but very rapidly, if it stays in this range from October 12th, from October 11th, it's still a negative, and then all of a sudden by the 17th, it really conforms to it. So these trades with a ratio or butterflies, they function at the very end of the trade, right before expiration. That's when they function. But for the most part, you're playing a range-bound trade. Yeah, absolutely, Mike. You want to see the Starbucks valuation? That's bucks. I love investing.com. Fair value $82. Starbucks trading right now at 83. We can tell from the stock price where it's going to be. We just did that. We looked at this chart. Starbucks is not like a magic company. They're not reinventing the wheel. They're not AI driven. They're selling coffee. They have locations all over the world. There are going to be a range bound stock. So the question is, how do we make money off of range bound stocks? Well, we do it by trading likely naked trades. That's why when I get these set up, I am not trying to define the risk on this. I'm just trying to ride the range. And the reason that I do this is because I want enough theta. This is only $5 a day in theta decay. It's not very much. So this is showing a probability of profit of only 32%, by the way, this trade. It's quite aggressive. But it's only a $5 in theta decay. It's not a ton. Seeking Alpha doesn't give fair market values. So, but what we saw the valuation finance. So, around 103, and then at minimum 76. And we know it's close to its price on the downside. Trader Bob says, Moo looks great for early exit. Thanks for that demo. Can you show an earnings play, maybe Adobe? Absolutely. Let's look at Adobe. Now, one of the things that you guys should know about Adobe, and this is why we get to work together. Adobe is highly undervalued right now. There is a fair market value 474. Stock's trading at 353. So as everyone in my trading group knows, I have a very bullish position on this. Interesting because Oracle also reports today. So let's look at Oracle. Its fair value is 174. Now there's a little competition on Moo right now, which is another cool thing. There's like a community center. So I'll be building that out as I get into the platform. I'll be, posting some stuff there and people can vote. And when there's a question posed this morning, which do you think is going to have the largest move? And it was interesting. They said the largest move. They didn't actually say largest gain. And so I assume the most people, when they're looking for earnings, they're not trying to use options. They're looking for a move to the upside. So typically move means positive. When I look at that fair market value, I look like Oracle and I'm thinking, well, there's lots of risk to the downside. I'm looking at Adobe, there's lots of potential to the upside. Almost everybody thinks that the Oracle is going to move upwards. So we're seeing 1% move today. Let's pull it up on Moo here. And I was a bit shocked as to how many people were thinking that Oracle would outperform Adobe. And I'm looking at these charts saying, okay, well, here's Oracle. This is Oracle. It has been moving. This is great. I mean, the trend is clearly to the upside. But fair market value, according to investing.com, is down here. So we have, let's just put that in here, 174. That's where the fair market value is to the downside. Now let's look at the valuation from Moo. It's got a strong buy rating. We've got this minimum 185 to 400. So again, there's potential. It could just go up. And it could go massively. So let's pull up something that we can do with for a trade. What if we wanted to do a bullish trade? This is how cool Moo is. It's like just pulling this up, $127 risk, $372 profit potential. This is a 25% probability of profit. This is the long, the 257 call expiring on Friday, September 12th, and short the 260, 250 call. Stock's trading at 240. So in order for this to make money, we don't get anything back unless it's trading above that 257.50 plus whatever we pay for it. So 127. There's a short put spread. We could do that. And let's turn myself off for a second. Similar sort of thing. Max loss 140, max profit 360. That's the 250 to 257. So which is, that has a better probability of making money. A little bit more risk, but has a 30% probability as opposed to 25%. So if we wanted a bullish position. Now, what if we were very bullish? What if we thought it was going to go to $400? You know, these trades, like this is 275. So the stock has to move considerably further. But boy, that's a nice return. Max loss $94. Probability of profit only 11%. And this is where we have to just decide, you know, like, what if we think Oracle's going to beat? Here is just a long call, the 270, the 267, max loss 305. If the stock price drops, you know, say the stock goes up to $300, then this trade makes $2,800. Max loss $300 though. That's substantial. Long covered call, max loss is considerably larger. You know, these buying calls or call spreads can be quite lucrative. I'm going to put in a trade. Let's just do this. Let's just see what we can do here. I'm going to do this. Amount $96. I've got 3 grand in here. Let me see if I can do this. I don't know what that's going to show, so I'm going to turn that off for a second. Yeah, it's not showing anything. This is just a small account, and let's see if that went through here. I've been trading mostly on my phone, so trade stats chart. I literally just decided to put a little bit of money in here. You see this $4,000 account. It's nothing here. Where's my order? Oh, I have to click the submit button. I'm covering it up on myself. Here's the submit button right here. So I'm going to hit submit. My order amount exceeds my cash buying power. Excess amount will use margin. That's fine. I don't even care. So I'm just going to go confirm. One nice little thing. So $96 debit. So we'll just put that on. I've already got stuff put in here. What I've been doing is doing cash secured puts in here. So I have cash secured puts, and that's what's taking out my buying power. But I don't mind paying a little bit for margin for this trade. We're just going to hold it overnight anyways. So I'll hold it for an hour, and then I'll take it off in the morning. And if it wins, then let's just go see if we've got this in here. Order submitted. Got a couple little positions in here. My orders are here, so that order is working. No data. Did it go in here? I don't see it. I might have to fuss with this. It's probably because I'm out of cash in that account. I've used everything for cash secured puts. Anyways, that's the demo. Trader Bob says Adobe September 12th, 345, 355 call. September 19th, 352 call. Plus 252 puts. How will IV collapse after September 10th affect it? Let's take a look. Let's just build it in here. Can we do that? 1, 2, 3, 4. Yeah, that's enough. I don't love playing diagonals over earnings. That is something that I don't love to do. So, but it doesn't mean it can't be done. Let's pull up the options chain, and we were looking at, we'll go to the chain here. I mean, this is just like anything else. It's pretty simple once you're used to navigating any platform. So we've got the September 12th, the short 345 put, and then -2 of those, and then short 2 of the 355s. So we're gonna go sell order here, and then the 355 sell those. We're going to, and then the September 19th. This is a double diagonal. Yeah, 2 to 3. I think especially with 2 to 3, it's the IV drop is going to kill it. But we'll take a look. Even on 1 to 1, IV drop sucks for the long positions, because what's happening right now is the IV right now on the September 12th is 116th. Well, this is just going to drop to nothing on the September 19th. So all the value is going to get sucked out of these positions. So this is we're going to look at the 252 put. I'm assuming it's the 252.5. And then the 252.5 call. So we've got a strangle, like a little straddle. We're going to buy 3. Oops. And then these are short. So we're going to do 2 to 3. And then we're going to look at the chart. So it's, it's showing, it's like, oh yeah, I can't lose on this trade, 100% probability of profit. But the IV drop, it's going to be negative. And it's going to be negative tomorrow, or whenever Adobe drops. So Adobe is going to drop on, but that's what happens. If the IV drops to 56, which is half, it really has to move. So the stock has to move either between 316 or 396. So that's why this IV slider is so important to us, because we know the IV is going to drop. The IV right now is 100 and something percent. So this I don't think this is an IV increase. I think this is actually like the IV ranking. So it would say, okay, if this time passed, and the IV stayed the same, it would work. But I don't think this trade is a great setup for a non-IV event. Oh, look, something just happened. I think that filled. I heard something. That sounds like Tasty Trade or Tasty Works. I've only ever done it on my phone, so I don't know that sound. Let's go to the account here and see what we've got. Security, I've got orders, 0 orders. So this filled. So I got some here. I bought for 190 let's scroll this over here. Oops, now I'm messing it up. I'm messing up the pre-format. I'm just trying to see. So the symbol here, the name are the same. Oh, that's kind of redundant information, but I am selling the Oracle 2025 September 12th call 285 strike, and I'm buying the 2025 September 12th call 275. I bought this for 190 and I sold this for 194, so I got 96 bucks there. Or I paid $96, and I have the ability to make the difference between the 275 and the 285. So what is that, like 900 bucks or something? It's a potential of making a lot of money, but the stock has to go to 285. So let's go to the stock again. We're past time. I had a break. This was like the first real break I've taken in actually quite a few years. So this would require the stock going up substantially. I mean, I'm probably just wasting my money doing that. 96 bucks is probably gone out of my pocket. But let's put a line. Let's move this line actually. Can we just move it? No. Let's delete that. Can I move this line? So I need that to go above 276. So that is a very bullish trade. But we saw those analysts, analysts think that it could go to 400. So this could be great. And there's a $4,000 account. So I'm risking 90 bucks. Worst case scenario, I lose 90 bucks. And best case scenario, I make a ton of money, right? 900 bucks, ton of money. Let's go. Now it makes me think, well, what am I being silly spending all that money? Let's go to Oracle, and I don't like to take risks like that. But let's go to options. Let's say, what if we were going to the strategy builder and we wanted like a neutral trade or can we buy, what if we did like what if we did a neutral trade here and just bought a butterfly that's on top of this? So 256, can we do something in here? It's low risk. 268, stock is collateral. What if we did like another bullish position, but we did it as a short put spread and we did it below? So let me go here and then let me buy this put here and sell this put. What kind of, take way more risk in here. So this expiration P&L would be 80 bucks and I have a risk of 165 on top of the $90 risk that I've already taken. So it, you know, wouldn't be very smart to do that, but let's just add them together and see what we do here. What are you guys saying? Mike Mueller says, I was thinking seeking alpha on Starbucks for its algo rating, probably a hold. I would assume it's a hold as well. Let me take a look in a second. I'm going to do buy a put or buy a call, sell a call. I'm going to get this. This is where what I would want to do is get myself in a position where I'm positive, and I have this amount of risk, but I have to take a bunch more risk. Now I've got a max risk of 655 bucks and I have a max profit of only 344. Like it's that risk reward really gets skewed when I start to do this. So I want this green line to stay positive. As soon as I move this too much, now it's negative again. It's a much smaller loss. It's only 34 bucks, but I'm also risking more. I've got 287 bucks, max profit of only 282. Where are, these are different calls. Let's get these calls into the place where we were. 275. The buy was at 275 and the sell was at 285. So got max loss of 286 bucks, max profit of 291. Probability profit's only 11%, and this is pretty cool. You know, like Interactive Brokers is not allowing me to do this. 67% probability of profit. Max loss 428 bucks, max profit 1,071, break even at 226. So if we were to go back to that chart, so now you know, my break even is currently there, but this one would be 226. Break even there, much lower. But again, more risk. So it depends on how much we're getting. Trader Bob says, your small Moo account sounds like a good setup for a 100K challenge, doesn't it? Yeah, I don't know what I'm going to do. There's going to be some videos coming up. Part of the agreement that I have with Moo is that I'm going to, you know, do promotion like this for them. They did fly me to New York, and this is pretty nice. Like, you know, put me up in a hotel, flew me there, toured me around, met a lot of people, talked about options. I mean, I'm already thankful that I'm able to work with them, but I'm mostly thankful that I like their platform. It's interesting because a year ago they reached out to me and said, hey, can you check out our platform? I looked at it and I said no. I just said flat out no. And they were even offering to pay me. And I said, no, I'm not interested. And they asked for notes. I gave them notes. They came back a year later and said, hey, look, we've integrated all of these things. We've improved our platform. Can you check it out again? And I said, okay, that's cool. So I checked it out and was like, wow, like almost everything that I asked for is now integrated in. And that was the exact same thing we were doing in New York. It's literally like I was talking to the UI designer. I'm talking to like they have quite a bit of a Chinese crew there. So you know, like their product developer, their obviously their marketing team as well, but we were like ground level talking, pointing out and looking at these the screens and saying, what does this make sense? Is this working? Can we, you know, can we change this? Does this work? As a user, I am like a power user. I do tons of trades. Like my portfolio has 100 trades in it all the time. So I need to be able to have my platform perform and function. And this is why I'm always looking for the newest, the best, and what people are looking to improve. You know, who's out there trying to really make it great for traders, because I'm a trader. I'm never going to stop trading. Mike says, also completely joking, but how can you be Canadian and not know how to pronounce my last name? Do I say it incorrectly? How do you say it? Is it not Mueller? Yeah. I don't know. I'm not French. I'm from the west coast of Canada, so my French is terrible. My German is way better than my French. Anyways, yes. Thanks for pointing that out. Obviously it's not pronounced that way, and you'll have to give me the phonetic spelling. My name's super easy, right? Some people screw it up. I get called Levy all the time for some reason. I don't quite get that, but especially since I have a gene company. Okay, I digress. It's 12:15. You guys are amazing. Thank you so much. What we're doing together is getting rich. So how about that? Let's get rich together. Talk soon. See my patrons on Thursday. If you guys haven't checked it out, head over to patreon.com/drawbridgefinance. Join the Discord. You can join completely for free, and we can chat there. Thank you. Appreciate it. Take care. Bye.